Over the past couple of years, inflation certainly has been a hot topic on most people's minds. But what is inflation, and what causes inflation to occur? Well, we're going to be having a deep dive into this topic today, looking at a few different examples of inflation and talking about how we can best protect ourselves from it. Let's start off by looking at what inflation actually is. And inflation can be described as the rise in the price of goods and services over time. As inflation increases, the value of money goes down, purchasing power goes down. This means that over time, the same amount of money will buy you less than it did before. We all know that inflation affects things like food, gas, rent, but it can also affect small things like everyday items. It can affect absolutely everything. An example of inflation is that if a loaf of bread costs £1 today, we'll assume that inflation is 3% over the year. The same loaf of bread will cost 103 next year, and it doesn't sound like very much when we word it like that, but imagine assets which are valued significantly higher, or if inflation is higher, right? Over time, it definitely adds up. Inflation itself is usually measured through the Consumer Price Index, and this is done annually. The intention is to track the cost of a basket of goods and services. Let's have a look at one model for inflation now, and this is demand pull inflation. This can be described as a scenario which happens when demand for goods and services exceeds the supply available. It's when more people want something and there's not the supply for it, therefore prices can rise. An example of this is, let's say a new tech gadget comes out and everybody wants to have it at the same time, but there's limited units available. Well, the price is likely to increase as there is high demand, and naturally, some people will be willing to pay more to have the privilege. This type of inflation generally happens in a growing economy, where people have money to spend, but the supply of goods has not kept up. That is not the only inflation model though, as we also have cost push inflation. This occurs when the cost of production for goods and services rises, and the businesses pass those costs on to consumers through higher prices. An example of it is if the cost of oil, let's say, rises significantly, transportation and production costs could also go up, because the oil is used for fuel and shipping. This leads to higher prices for goods like food, electronics, and even clothes, as the transportation costs are factored into the price. This kind of inflation often is caused by factors like rising wages, increases in raw material costs, or disruptions in the supply of goods. Then we have the concept of more money in the economy. Sometimes inflation is caused when there is too much money circulating in the economy. When central banks, like say the Bank of England or the Federal Reserve, print money, the overall supply of money increases. But because the amount of goods and services stays the same, the value of the money drops, which leads to inflation. The example that we've given here is that if a government prints more money to help stimulate the economy, people may have more money to spend, but if businesses can't keep up with all of the extra demand, prices will likely rise. This is why central banks carefully control the supply of money in the economy by adjusting interest rates or engaging in policies like quant. Then we can talk about external shocks. External shocks are unexpected events that disrupt the economy and cause inflation. These can be things like natural disasters, pandemics, or geopolitical events like wars. When these shocks occur, supply chains can be disrupted, making it harder for goods and services to be at the price that they used to be, right? The prices can rise, it's harder to get these things. As an example, in the COVID pandemic, which we saw, there was wide supply chain disruptions, especially for industries like electronics, construction, and food. This led to shortages and price hikes, contributing to inflation in many parts of the world. These shocks can be quite unpredictable, but their effects can last for a long time, depending on the severity of the industry involved. Wage price inflation occurs when businesses raise wages for workers, and in turn, businesses raise the prices for their products to cover the higher wages. This creates a cycle where wages and prices continue to rise together. An example is that if a fast food restaurant raises the wages for its workers, it may increase the price of a meal to make up for the higher labour costs. This can happen over multiple industries, and if it does, the cost of living as a whole can increase and inflation can rise. This type of inflation can be problematic if wages don't keep up with the rising cost of living, and it can certainly erode the purchasing power of consumers. Now let's talk about how inflation affects you. Inflation affects everybody in different ways, depending on what you buy and how much you earn, but here are the main ways that it generally impacts people's lives. Number one is higher prices for everyday items. As inflation increases, things like food, gas and rent become more expensive. You'll need more money to pay for the same items you could afford last year. This brings with it reduced purchasing power. Your money doesn't go as far as it used to, and this means that you might need to adjust your budget to cope with higher prices. Savings also lose value. If you have your money saved in a bank account that earns little to no interest, inflation can erode the value of your savings over time. For example, if inflation is at 3% per year, but your account only earns 1%, your savings lose 2% in value each year. Then there's the impact on investments, as inflation can also affect the stock market and other investments. Some investments like stocks and real estate may grow faster than inflation, but others, like bonds, might actually lose value. So let's have a quick recap here. We've covered a few models of inflation. Demand pull inflation, we've talked about cost push inflation, we spoke about the fact that you can have more money in the economy leading to money losing value. We spoke about external shocks and prices and wages. All of these factors can contribute to inflation, and understanding them is important to make smarter financial decisions. So with that being said guys, thank you so much for watching this video. I hope it was useful. If you enjoyed it, don't forget to leave us a like and subscribe. Do leave a comment below. Thank you for watching, and I'll see you again soon.